Both the Moving Average Convergence Divergence, MACD, and the Relative Strength Index, RSI, rank among the most popular momentum indicators used in Forex trading. When used in combination with other technical indicators, both MACD and RSI can offer value in validating trade opportunities and timing trades to optimize your risk management practices. While they represent a similar approach to evaluating Forex trades, the functions of both MACD and RSI are distinct, which makes them useful indicators to combine in trade evaluation. Here's a look at how to use MACD and RSI as part of your trade analysis. The basics of MACD is a momentum indicator that illustrates the relationship between the 26-day and 12-day exponential moving averages for a Forex currency pair. This relationship is presented on a histogram that offers an easy visual representation of both the strength of a Forex price trend as well as signals that may indicate a change in momentum. On the Swiss franc to Japanese yen chart below, the gaps between the 26-day EMA, the blue line, and the signal line, the red line, correlate to the momentum of the price movement. The larger the gap between these lines, the stronger the trend in either direction. When those lines converge and then cross over one another, it can indicate a shift in momentum that traders may use to time their exit from a position or to plan a new position that aims to capitalize on this opportunity. In the chart below, two such crossovers coincide with changes in price movement for the currency pair. Key MACD indicators to watch when evaluating MACD to identify trading opportunities. A nuanced approach to analysis can help you identify particularly strong momentum for big price swings that can quickly deliver profits or losses, depending on which side of the price swing you're trading on. The two significant patterns that develop from an MACD crossover are known as the golden cross and the death cross. And quad. These patterns are virtually mirror opposites, but identifying them is critical to making the most of MACD in your trading strategy. Golden cross. This bullish indicator typically sees positive crossover taking place after a price dip marked by high volume selling. After the sell-off has finished, the price begins to gain in value, and the crossover takes place with significant upward momentum that lifts the price well above the crossover line, resulting in a sizable profit for traders who identified the preceding dip. Death cross. This bearish indicator is the inverse of a golden cross. Prices are inflated as buyers gobble up the currency, but once this demand is satisfied, the price plunges, resulting in a crossover that has significant downward momentum. The basics of RSI Relative Strength Index is a 100-point scale that depicts the momentum of the price movements for a given Forex currency pair. This simple chart is divided into three sections to clearly identify overbought or oversold conditions based on those momentum swings. While RSI also measures momentum, it reflects this momentum through a different analytic approach. RSI can identify buying opportunities by pinpointing trade opportunities where conditions of a currency pair are either overbought or oversold. In situations where conditions are overbought, RSI suggests that the price may be inflated and primed to decline. In oversold conditions, RSI suggests that traders may have overreacted and have now created value by depressing price and demand. For a currency pair, the functionality of RSI is evident in the pound sterling to US dollar chart below, where a dive into oversold conditions below the purple range on the RSI graph leads to a quick price increase for the currency pair.